When applying for a mortgage, ever wonder how a lender determines how much home you actually qualify for? Is it all based off of income, or do things like down payment, credit, or what about even getting a second job? Can those affect how much of a home you qualify for? Hey guys, Manny Sarnes here with Home Team Lending, and today we're going to do an in-depth dive on how a lender determines how much of a home you actually qualify for. Now, as a lender, there are actually two factors that play the biggest role in determining how much money a lender will actually loan you for a home. These are called debt-to-income ratios, or some of you have heard the term DTI. Now, we actually have two DTI numbers we're really concerned about. The first is what's called the front-end DTI. Now, a front-end DTI is your housing payment. A housing payment consists of principal and interest on your mortgage, property taxes, and homeowners insurance. It can also be derived from homeowners association dues and mortgage insurance if those are applicable on the house and mortgage you're applying for. So that total payment, that total housing payment, if you were to take that number and you were to divide it by your gross monthly income, that factor is your front-end debt-to-income ratio. Now, with most mortgage programs and most aggressive numbers we see, they typically want your housing payment to be 40% or less of your gross monthly income. So that's how they determine initially one factor of determining how much of a home you will qualify for is that front-end DTI, which is your housing ratio. Now, the second factor they look at is called a back-end DTI, back-end debt-to-income ratio. So what drives this factor? Well, if we were to take that same housing payment, remember, a housing payment is your principal and interest on your mortgage, your property taxes, your homeowner's insurance, okay, and potentially mortgage insurance and homeowners association dues. So like on condos, right? $300, $400, $500 a month can greatly affect that housing ratio. So in the back-end DTI, we were to take that housing ratio and then add to that monthly payment any monthly debt that appears on your credit report. Now this is things like your automobile payment, student loans, credit card debt. Some things outside your credit report can actually be taken into account. Things like maybe if you pay alimony or child support. So when we take the housing payment and then add those other monthly liabilities that appear on your credit report, we get a total monthly obligation. Now, when we take that number and we divide that by your gross monthly income, that gives us that back-end DTI. And for the most aggressive mortgage programs that we're looking at here, normally the highest they want that, your total monthly obligation, to be 57% of your gross monthly income. So in a recap, you can use 40% of your gross monthly income on your housing payment and up to 57% of your total monthly obligation, which is your housing payment plus the things that appear on your credit report, 57% of that number against your gross monthly income. Okay, those two numbers, a maximum of 40 and 57%, is how we determine how much money you can borrow. Now, that's just in a nutshell. What does that really mean in real life? So let me give you a real life scenario. So let's say you make $60,000 a year. You take that number, divide it by 12. Your gross monthly income, right, before Uncle Sam touches your payment, right, your gross monthly income is $5,000 a month. So that front-end ratio is what we said, 40%. 40% of $5,000 a month can be used towards a housing payment, right? So you can use $2,000 a month of your gross monthly income towards your housing payment. Now, the back end, the DTI, the back end DTI, 57%, okay, of your $5,000 a month, that's $2,850. So we take that $2,000 a month housing payment and add up anything that appears on your credit. That total number shouldn't exceed $2,850. So that is a real life scenario, and we're using the 40% maximum front end and the 57% maximum back end to derive a sales price. And when you work those numbers backwards in today's market, that's roughly a $250,000 to $270,000 home. Now again, there's a lot of varying factors like taxes and insurance. What interest rate do you qualify for? These can vary that sales price. So again, these are just some rough rules of thumb numbers to give you an idea of what that lender is looking at and the numbers they're using to qualify you for a maximum sales price. Now, what are a couple things that can help? Let's say you're not getting qualified for the amount of home you want. Let's say you're making $60,000 a year and they're qualifying you for an amount and you want to try to get more of a home. What are some things you could do? Well, the first thing and the quickest thing that you can do is you can add a co-borrower. Right? If you add somebody that brings some additional gross monthly income to the table, well, those DTIs are going to greatly shift. So adding a co-borrower, that can greatly increase your ability to purchase more of a home. Co-borrowers do not have to be spouses. They don't even have to be family members. You can get somebody to help you purchase that home, and then we still look at their credit and their life scenario, but that income can help quite a bit. Now, if you don't have somebody, or maybe you have a co-borrower and you're still not getting the numbers you're looking for, another thing you can do to increase your buying power is possibly paying off some small credit card debt. Paying off credit card debt is actually giving you two benefits here. The very first of which is it's going to be dropping your back-end debt-to-income ratio, right? You pay off a credit card, that monthly payment goes away, that decreases your total monthly obligation. But another derivative of that is your actual credit score should go up. So as credit scores go up, okay, your qualifications get better. So paying off small credit card debts is a really good way to increase your buying power when qualifying for a home mortgage. So these are two things that we really highly recommend. The third thing, if available, you can increase your down payment. Increasing your down payment is a really good way to increase buying power. It's one of the hardest things to do though, right? So you can either slowly over time save money to qualify for more of a home, or you can get a gift from a family member, or you can maybe pull money out of a retirement account. We're seeing that happen a lot right now. People pulling money out of retirement accounts to go ahead and put it towards the purchase of a home. So those are a couple ways to increase buying power. Now, common misconception I get a lot. Well, Manny, I need to increase my gross monthly income, okay, to qualify for more of a house. I'm gonna go get a second job. Well, not so fast, because lenders understand what they don't want to see you do is go get a second job just long enough to qualify for a mortgage, and then you quit the job. Remember, our mortgages are anywhere from 10 years to 30 years. So having a second job for a couple weeks or a couple months doesn't give us a lot of comfort feeling that you're going to be able to make the mortgage payments over the next decade to 3 decades. So most guidelines require you to carry a second job for anywhere from 12 months to 24 months. Underwriters figure, listen, if you're committed enough to working 2 jobs for at least a year, sometimes 2 years, then you're committed to having that second job. Now we are willing to allow that to be added to part of your gross monthly income. Now, as always, these are rough numbers. What you actually qualify for and your maximum debt to income ratios, again, they're determined on things like credit score, work history, how much down payment you're putting down, the type of reserves you have. You can see some of our other videos where we talk about assets and what does reserves mean and how the down payment affects my buying power. So what we wanted to do today is hopefully pull the veil back on debt to income ratios, what they are. We know we hear about them a lot, how lenders view your debt to income rate. Remember, a maximum of typically 40% on your housing ratio, 57% on your total monthly obligations, but these can change. Conventional, these are not as aggressive. Those numbers are lower. We're talking about some of that, like a mortgage like FHA or VA will allow some of these higher, more aggressive and higher debt to income ratios. Again, we get a common misconception sometimes that maybe an FHA or VA buyer is not as good as a conventional buyer. No, sometimes they just want to get more of a home for their gross monthly income, and they do that by switching out of a conventional loan product and into a government product like FHA and VA, which allow for these higher debt to income ratios. So again, please subscribe to our YouTube channel. We've got all sorts of great information about purchasing your next home, purchasing your first home. And as always, guys, I'm Manny Sarnes from Home Team Lending, your favorite lender.